Okay, welcome to my new website where I use some old school chart techniques to try to make a little sense out of these markets. And I've been doing this for probably about 15 or 16 years, both actively investing and trading, and also when I'm not doing that, just studying the charts without the emotional baggage of having always having skin in the game. And believe it or not, that's actually when I've learned a lot of what I've picked up. When you're not emotional and trying to create things out of charts that you want to see, it's a lot easier to be objective. If you are looking at a stock or maybe an index where you don't have any profit or loss motive. Anyway, I'm going to look at the S&P chart for the last 6 or 7 months, and just a little background. This is a chart that shows the April high around 1220, which was about 70, roughly 70% or so from the lows of 660, and or maybe even more in the S&P. But anyway, we had the flash crash. Prices came back. By the way, this took out a trend line right here. But some people are saying the flash crash was somebody with fat thumbs or fat fingers or something like that. I'm not convinced. I think that the market, having rallied as far as it had, I just think there were a bunch of stops in, and as soon as these things started getting taken out, boy, it just fell in a hurry. We had a pretty good rally come off of that, almost get back for a back test of the broken trend line, not quite. Then we had a series of fluctuations in all of the indices in a pattern that I believe indicates this was a consolidation after a market correction, and now we're going to head back up. Let me tell you why I think that. First, if you look at a couple of these gray trend lines, this one and this one, you could almost make the case that what is bounded by these two lines here and here looks almost like a bull flag. And now watch what happens. We had a breakout over this trend line, come back up to this same level, about 1123. Then prices came back for where? Almost a perfect back test of this broken line. Prices came back. Now they paused at the neckline, and now they have taken off and have broken out, consolidated for a few days last week, and now it appears that we're going back up. Now, here's the way this pattern works. You can see the potential of a bull flag right here, but the pattern that I'm really most interested in is this dip, and that dip, because these three valleys make a very nice little inverted head and shoulders pattern. If you look here, we've got a clear neckline. We've got a neckline that was broken. We have a pullback here with those two red candles, came right back to the neckline. Then we bounced around a little bit, not unusual, and now prices started to move back up late last week. Oh, by the way, this green line, if we back out on this chart, we're going to back out a little bit more here. This green line is drawn across the market top of the bull market back in October of 2007 and over the top of April 2010. Now, if this were just a bear market rally, I would not have expected prices to move over this green line. I would have expected that to have been an area of resistance. I also would not have expected a pattern to develop that has an implied move to the upside that is significant. If we measure this, if we draw a little line from the neckline down to the bottom of the head, there we go, move this to the neckline, we get a level of about 1250 as the expected move from this pattern. Now, when we get there, will it back up and come back for another test on this line? It may. Could it possibly even be a nasty double top? Well, that's something you need to watch out for. But as things look right now, it appears to me that the indexes are poised for more gains. And I don't think the market's really expecting that. So many websites I visit are totally bearish, even to the point to where they're calling this, what did somebody say? This is a fake market or a fake rally. Well, I don't know about you, but when I look at the money I've got in the market, the gains do not appear to be fake. They appear fairly real. So anyway, good trading to everybody, and I just want to remind you, you trade at your own risk. I'm not an investment counselor. I'm not a broker. I'm not licensed to do anything. I'm doing this because I enjoy it, and I think there's some value in learning some of these old school chart techniques. You'll notice I didn't show you any MACD, stochastics, RSI, shaken oscillators, or ADX, or I didn't show you any of that stuff. I'm just looking at what the historical movement of the prices has been. Just one more quick word here. There's been some talk about this rally being on weak volume. I don't know exactly what to make of that. I've got some theories. One theory is that when we enter this kind of chop that we've had for the past 5 months, you know, there's the high frequency trading where the average hold time on a stock is like 13 nanoseconds. I suspect that we get a lot of inflated volume from these high frequency trades, and when the markets begin to straighten out and establish a single direction, such as we've had from here to here, there may not be as many opportunities for these high frequency trades to take place. And therefore, the volume may appear to be artificially low. That's just a theory. I'm not saying that's what it is. But for now, that's my story, and I'm sticking to it. Good luck in the markets. Watch this green line. Watch this purple line. They need to hold up. This one could break. It could come back down for another test of this neckline. But this 1122, 1123 area should be something of a line drawn in the sand. And right now we're on the Bears. We just scored a touchdown. We crossed their line, and I'm thinking that we're going to see some more progress in the upcoming week. And take care. Good trading to you. Trade at your own risk, and we'll see you again soon.